Here she is.
Good morning.
Good morning, Lori. How we doing?
Listening.
Just let me turn off the television. That would be a bit of a distraction, I think. All right. Are you ready for chapter 10?
I am.
How was your weekend? Okay.
Pretty good. Yeah.
All right.
Uneventful, but that's
Well,
okay.
in this world today, uneventful is good, huh?
Exactly.
All right. Let's see what we got here. We're skipping chapters 7, 8, and 9 till the end of the class, right?
Right.
You look at the module. And the reason is the 7 and 8 are about payroll, and 9 is about bank reconciliations and things. So we'll go into chapter 10. We'll learn a couple new accounts. And let me get my slideshow going the way I like here. All right, here we go. Chapter 10, accounting for sales and cash receipts. And chapter 10 is kind of a 2-for-1 in a way, Lori, because chapter 11 is about accounting for purchases and cash disbursements. Okay. So they're sort of reciprocals of each other with certain differences. Okay. So sales and cash receipts, what we're going to be talking about now is a company bills out to their customers X amount of dollars in merchandise. But guess what? People return things, right?
Mm-hmm.
So we have to reduce those sales. People maybe come back and they negotiate a different price, or there's what's called a sales discount. So let's see what we have here. Learning objective: merchandise sales transactions. What we're talking about in here is we're a store, basically. We're Nordstrom's, we're Macy's. Okay, we purchase merchandise from somebody and hopefully sell it to somebody else for more than we paid for it. Okay.
Mm-hmm.
And they get into a little not detail, but they get into some of these items that are really not that important in learning the material. But we know what a retailer is. A retailer sells to the end user. Okay. Macy's is a retailer, sells to final customers. And then they talk a little bit about what they call source documents that back up what happened: cash receipt, cash register receipts, sales tickets. They're just talking about the paperwork, if you will, much of which can be just done online. Sales ticket, I don't think we need to look at it, what's called a sales ticket. We all know it's an invoice, basically, is what it is. The wholesaler is the middleman, huh? That's who provides merchandise to Macy's. That could be a big clothing company or somebody like that. Could be Guess Jeans or somebody. And they sell on account for the most part, huh? On account means accounts payable. And they generate an invoice. And they're talking about one copy goes to the customer, one goes to accounting. This is kind of basic things that are still important. But years ago, when you didn't have the computers going, these copies of documents were so crucial to maintain, get in the right hands at the right time. And they're just talking about the process a little bit. Customer orders something from us. We get what's called a purchase order from them. And we're going to interpret it. We'll make sure we can sell it to them. And then we provided copies of invoices, okay? And an invoice. Do you have any question on what an invoice is, Laura? You've probably been paying them for a while, right?
I do them every day, so no. I generate them and I pay them.
There you go. Invoices. An invoice is what you just buy, what you just bought. Here's your darn receipt, huh? A credit memo. Credit memos, debit memos. You don't hear these two words much anymore. But what it is, it's simply permission from, in the case of a credit memo, it's permission from the seller to return the goods. That is basically what it is. It's issued by the seller, indicating that the customer's accounts receivable has been credited for the amount. Maybe you returned something. Maybe you negotiated a lower price. And they talk a little bit here now about the copies of the credit memo. But basically, this is what it is. You call the store and say, can I return this pair of shoes I bought? They say, yes, no problem. That, that's the credit memo, okay?
Mhm.
It can be just an email. You get the idea. It's a used to be, not gonna say used to be, but it's a document that provides the buyer with proof they're allowed to return this stuff. Okay. Credit memo, debit memo is the next chapter. And here's a credit memo. It's just looks like just like an invoice, right? You can read these numbers, right,
Mhm.
Lori?
Yep.
Yeah, I mean, here it is. All they're saying here is it's a credit memo. So they're saying you have permission to return this gyro reverb helmet for which you paid $46 plus tax. That's all. So you would take this piece of paper probably and bring it to the store or mail it to them or something saying you want that credit. You can get the credit in cash, obviously. But what else can you do with it besides getting it in cash? You have any thoughts on that, Lori?
Store credit.
Exactly. You just tell them I don't want the money. Take
Yeah.
$48 off my next purchase. Absolutely right. Describe and use merchandise sales accounts. That's a nice, clean, easy slide, huh? That's all there is to it. Okay, here we go. Now we're seeing some new accounts. All right. To account for merchandise sales transactions, we will use 5 new accounts, huh? Well, sales is not a new account, I don't think, but sales, okay? Your revenues, you sold something. But suppose there's sales tax involved. You must collect that sales tax from the customer, obviously. The sales tax is paid by the customer. Excuse me, not the seller. Could you excuse me just 10 seconds, Lori, please? Gotta run over here. Okay, shot. Sorry for that. Sales tax payable. You sell something for $50, $3 sales tax, you're going to credit your sales, right?
Mhm.
And you're going to debit your accounts receivable for the 53. So that leaves us with a credit of $3 to sales tax payable. Sales returns and allowances and customer refunds payable. You can add credit cards to that. These are called contra revenue accounts.
Mhm.
You never debit sales. And I've got the guitar here to sing the song if we need to. You never debit sales. Never. Okay, class, you never debit sales. What you do debit are these contra sales accounts, sales returns and allowances, sales discounts. Okay, so let's see what we have here. And they're not putting any numbers in here, but they're just kind of getting us started. Accounting for merchandise. Notice they put in a new account called sales tax payable.
Mhm.
Okay. Now we have sales. We already had sales. Now you have the contras with a debit balance. Okay. So those sales, think of those as gross sales. That's how much we build out to customers. We build $1 million to our customers this month, but maybe 10,000 was returned to us, or the customers took what's called a sales discount, which we're going to talk about. You see where it says customer refunds payable?
Mhm.
Ignore that.
Okay.
Ignore it. We decided that we're not going to teach that for a couple of reasons. Apparently, most of the accounting world is not even familiar with this customer refunds payable. It's basically you anticipate the amount of refunds customers are going to bring back. So we're not going to worry about the customer refunds payable. Okay, so we're talking sales minus the debited contra revenue accounts, the contra sales accounts. That'll give us net sales. The sales account, it's a revenue account, huh? It's credited for the selling price. And that's kind of an important point because students get confused a little bit when they get the sales tax involved. And if they're trying to unwind a little bit of a problem, they get a little mixed up. Keep in mind that the sales account is always a multiple of the units purchased, of the units sold rather, times what your price was. It'll never include any of these ancillary things, okay? Sales. I sold $1 million times $1 to somebody, and there was sales tax and there was freight and different things. The million is what goes to sales, okay? And they're saying, here's our entry, which we learned in chapter 2, I guess, huh? Debit cash, credit sales. There we go. Or debit AR, credit sales. In this chapter, we're pretty much talking only credit sales. Now you know why I had to run away for 10 seconds. You know Jackie Gleason, right? My favorite hero.
Mhm.
Remember, he used to drink, oh, that's good booze. That's what it feels like here. All right. Sales account. Okay, sales tax payable. This is a liability account. Liability account. It's used to record the sales tax collected on sales. Oh, I'm sorry. That we, the company now owe to the state of California, right?
Mhm.
We get a sale and there's sales tax. We're going to credit the sales tax payable for the amount of that sales tax. And most states require retailers to collect sales tax credited when the taxes are collected on sales made.
Mhm.
Debit to the account when you sell it, rather credit to the account when you sell it. But what happens if a customer returns something, Lori? Then you've got to debit it to take it out of there.
Right.
And some of the students can fall into that trap too. They'll see that somebody bought something for $50 plus $3 sales tax payable. And maybe the question is, how much is the credit going to be? How much is the return? And they forget about the sales tax until you got to remind them. Think about it. When you go to the store and you return something, do they keep the sales tax and only return the merchandise? So some of it is just a little bit of mild analytical thinking, I suppose.
Mm-hmm.
Sales tax payable. Here we go. If a cash sale for $100 plus 5% sales tax occurs, look at what we have here. Cash, 105. I wish that said accounts receivable, but that's okay. Cash, 105. Sales, that's the merchandise. We sold a $100 book and sales tax payable. Now the customer has paid their sales tax to us, and we have that fiduciary duty to turn it over to the state at the end of the month. Okay. And remember, you're never good at debit sales. Never, never, never. Here's what I wish they had put on the prior slide. If it's an accounts receivable, same thing, right?
Mm-hmm.
Same thing. Accounts receivable. Now we're going to get involved in what happens if a customer returns this stuff. They return part of it, or they take what's called a sales discount, which is we'll be learning quite quickly here. Okay, our first contra account, sales, returns, and allowances. Contra revenue account, meaning it has a debit balance. All contra accounts are married to something. Remember accumulated depreciation and the building, and some others. Okay, so a contra revenue account has a debit balance shown as a deduction from sales on the income statement. And that's what we're going to see later. You look at any company's income statement, it's going to say sales less sales returns and allowances, less these other couple of things, okay? And it's shown as a deduction from sales, and it's debited rather than sales, because you never debit sales, so that the business can more readily keep track of this activity. In other words, businesses, if you made the mistake, Lori, of debiting sales, your financial statements would still come out correct. You'd end up with the same net sales, but you'd lose the picture a little bit.
Right.
You say to yourself, geez, we have just one sales number. Didn't people return things? How much did they return? How much did we really sell? So obviously you want to keep these things separately, okay? And here's an example of the sales, returns, and allowances account. And they got permission to send it back with the credit memo, which is something out of the 19th century, okay? Refer to the credit memo. The entry for the return of the riding helmet is shown below. Well, They bought a riding helmet for $46. Remember, that was the invoice. Remember, that was the exact invoice we saw earlier. Okay. So they don't owe us $48.30 anymore. We must refund to them the whole $48.30, including the sales tax. So how do we eliminate the sales tax payable? With a debit. And how do we reduce sales? Not with a debit to sales, but a debit to sales returns and allowances. Making some sense, Lori, as we go
Yep.
along here?
Yeah, it does.
Not too bad. You have this in your business, sales returns, stuff like that?
Oh yeah, sure.
Okay.
Mhm.
There you go. You're not debiting sales, are you?
Yeah, no, I don't know. QuickBooks does it.
Okay. Sales returns and allowances. Here is the stuff we're not going to worry about. These refunds payable. Okay. The faculty got together a couple of years ago and we were looking at this, and we all said this is something that we don't think is pretty normal in the business world, so we don't go through it. And I'll triple check with Cornelia. I'm on the record here with my own words, and I'll make sure that that's not going to be on the test. Here's something interesting, Lauren. Sales discounts. A contra revenue account used to record discounts given to customers who buy merchandise on account. Now, this is not what you might call a trade discount. You look in the newspaper and you see that Goodyear tires have a sale, $50 off. That's not an accounting transaction. You walk into a store and they say half off on all the bread in the store. What we're talking about here is a very specific discount offered by sellers to customers to encourage them to pay early. Okay. So we want to get our money quickly, and we're willing to give away a few points to do that. Prompt collection of accounts receivable reduces risk that receivables will become uncollectible. I don't think they needed to put that in there. Yes, the best way to make sure your receivables are good is to collect them, huh?
Right.
So sales discounts is a contra sales account. Thus, it has a debit balance. And on your income statement, you're going to start with sales, maybe minus sales returns and allowances, minus sales discounts. So here's what we're talking about, Lori. Are you familiar with this 210 net 30? Have you seen this before?
Yeah, I offer a 1%, 10 net 30 for my.
Okay,
account.
good. That's very generous of you. We'll talk about that in a minute here. Okay, here the example is 2% 10 net 30. What that means, everybody, is you get a 2% discount if you pay within 10 days of getting your invoice. If you don't pay within 10 days, you have to pay the whole amount, the net amount in 30 days. And that's read as 210 net 30, 2% discount off sales price if you pay in 10 days. Otherwise, the total amount is due. And you could have 1% 10, which you just said you had, right, Lori? 1% 10 net 30. 210. This one here is called 2% end of month, where you pay the whole bit in 60 days. You can have different things here. Now you're providing 1% net 30, right? 110 net 30, Lori. So that means every 20 days you're giving people 1% of their money, right?
Mm-hmm.
There are 365 days in a year. Would you agree?
Mm-hmm.
You divide it rather by 20. The 20 days that the people are giving up the money, you're actually paying them 18% a year. So it's a big chunk of money. And people would be nuts not to take advantage of the 1%. Your customers pretty much do that?
The ones that I offer to, they do, yes.
Yeah. 1% 10, 2% 10 comes out to like 37%, etc. It's a real multiplier. Back in the 70s, when I was in school or getting out of school, 70, 74, around that time, inflation was roaring. If you wanted to buy a house, you'd have to take a mortgage of like 18%, believe it or not. And in those days, 1%, someone would look at that and say, I'm not going to take it. You'd be silly to take it. Today, that would be quite a good deal. And they're showing us our journal entry for sales discounts, huh? If merchandise is sold for $100, credit terms 2%, Somebody pays us early. Well, first we record the sale. We do not worry about the cash discount until they pay us.
Right.
So we record the sale. At that time, we don't know if they're going to pay on time. And now we received a check in the mail for $98. We debit cash for 98. How much did they owe us? 100. We credit accounts receivable for 100. The difference is our debit to sales discounts. And we have just reduced our gross sales down to what we're going to call net sales. Okay. You said most of your customers, do you ever have customers who pay after 10 days and they still take the discount?
Yeah, they do.
If I may, what do you do with that?
I give them the discount. I only have a couple of distributors that are offered the 1% 10, and generally it's within a couple of days, and so it's just not worth it to me to fight with them about it.
There you go. Yeah, you just did my part of that part of the lecture for me. Yeah. I mean, think about it, class. You have a big customer, and this guy buys a lot of stuff from you, and he always pays on time. He pays within 10 days, and then one day he went on vacation and he didn't pay for 20 days, and he took the discount. Are you going to call that guy up and say, "Hey, you bum, I want my $20"? You know, there's a lot of judgments involved in business, right? Sales discounts. The accounts receivable ledger. Now, I know you have this in QuickBooks, huh? The accounts receivable ledger. That's simply, look at this. They go describe and use the ledger, and then they go to a different subject. But we'll work with them, huh? The accounts receivable ledger looks just like your general ledger, except instead of having a ledger account for cash receivables, you're going to have one for customer A, customer B. And as you're entering your input into your general ledger, as you're preparing those journal entries, you also have to open up the receivables ledger and kind of do the same thing. Now, I'm sure in QuickBooks, they do that automatically, right, Lori?
Yeah.
Okay. So anyway, they took us on a little side trip that we'll return to later. I've learned to just flow with the slides rather than bounce around them. Okay. So what do we have here? We have transactions. Sold to Enrico Lorenzo. Oh boy. Sounds like one of my buddies from Central Jersey. Okay, we sold something for $1,520. That's going to be the sale amount plus the sales tax. Sold to Brenda Myers plus sales tax, account. So all of these transactions are the same exact situation. Pretty basic. Let me blow this up for my eyes, if not yours. Zoom. Okay. So let's take a look at them. The transactions are the same. We sold something. We sold a used car for $1,520 to Lorenzo. There was an amount of sales tax on it of 5%. So Lorenzo has to hand us a check in the future for the total. That's your debit, 1,596. He owes us that. The sale, though, is 1,520. You can't call that a sale for 1,596. That would inflate your sales, be misleading. And then when it's time to pay the sales tax, you'll never be able to figure out what happened. So look at the journal entry. It's going to be a debit to accounts receivable and these two credits. I don't think that's too tough, Laura. You okay there?
Mm-hmm.
Okay. Sales tax payable, that's a liability, everybody. And the sales tax is paid by the customer. But once you get that money in hand, you have a legal responsibility to turn it over to the state. Okay. So we saw those entries. We debited receivables, we credited sales and sales tax payable. Now we go to the general ledger. The general ledger. And we know how to post to the ledger now. We enter the date and the amount and the new balance and maybe a reference number. And in the journal, enter the ledger account number in the PR, posting reference column, I believe that is. So let me zoom this guy too. Let's see what we have here, okay? All right. Here is our journal entry we just saw, right? We debited accounts receivable and credited the sales tax. And all they're showing you here is you bring them over. Now, how come my finger suddenly doesn't work? That's very annoying. Right. Oh, it might not work on the Zoom, huh? Hold on. Zoom. Oh, here we go. I think I'm making too big a deal of this. Oh, for heaven's sake, come on. Here they're just showing you the journal entry brought down to the, it's harder for me to present it than it is to learn it, right? Accounts receivable. We sold this, remember, Lorenzo, 1596. Brenda Myers, 462, etc. You had 6 of these. Balance is here. You keep the balance going. They suggested you put a post-reference number here of some kind, and that's the receivable side. Look at sales tax payable. You had none at the beginning of the period. I guess that makes sense. You paid it at the end of the month, you paid off all the sales tax payable. So you would likely start off with no balance, possibly, if you pay right at the end of the month. And they had a couple of sales, so now they're building up that balance there. And sales. You're never going to see a debit here. Remember, you're never going to see a debit. Can't emphasize that enough, okay? So that was the general ledger. That's the general ledger, the big thing. The control accounts, they're called, the control accounts. Cash, receivables, inventory, payables, sales, electric expense, etc. Now we have to do the same exact thing we did here to the accounts receivable ledger. And this is a subsidiary ledger. It's not the control account. It's a detail of the control account. In other words, your auditors are going to come in at the end of the year and they're going to say to you, how much do you have in accounts receivable? Well, you're going to look at your general ledger and you're going to say, well, we have 14,058. Okay, we'll pretend we're a big company. Okay, they'll say, well, who owes that money to you? Here is where you're going to take them, to the subsidiary ledger. And that's going to be a T account, if you will, a ledger for each customer. And it's going to equal the accounts receivable balance. That's why it's called the AR ledger. You add all these subsidiary ledgers up, it'll equal the total for accounts receivable. Each customer is assigned a separate account number. A summary accounts receivable account maintained in the ledger is the control account. Here we go. In the accounts receivable ledger, you could do the same exact thing. You're going to enter the date of the transaction. You're going to enter the amount of the transaction, come up with a new balance, put a reference number in there. It's no different than what you did in the general ledger, except you're not going to have just one accounts receivable account. You're going to have Lorenzo, Myers, one for each person. So let's take a peek here. Time to Mr. Zoom. Okay, let's see if the old finger works. There we go. So there's our same 2 journal entries, right? And this is what we just looked at here. Steve's annoying me. Okay, here we go. General ledger. This is what we just looked at, right, Lori? We have accounts receivable. We had a sale of 1596 and 462. Now we're going to take that accounts receivable and we're going to take this control account and we're going to break it up by customer. So Lorenzo owes us $1,596 and his balance went up. Same thing with Brenda Myers, 462, and it went up. Looks like we're a company in Kansas, huh? You ever been to Kansas, Lori? I've never been there.
Once, a long time ago.
Kansas. Okay. Kansas. Do you have any questions on the use of the accounts receivable ledger, Lori?
No, I think I'm good with that.
Yeah. Yeah. Whatever you do in the general ledger for accounts receivable, You have to do it for Lorenzo. You have to do it for Myers and John, whoever the people were. And of course, these balances here, the 1596 plus the 462, that has to equal your general ledger. And it does, because they're not showing you these 12,000 to begin with, okay? Relationships to remember. Relationships, my goodness. Entries in the general ledger are posted to the general ledger and accounts receivable ledger. They're married, you know. After the posting of the AR ledger and the general ledger is complete, well, the total of the accounts receivable ledger balance should equal the accounts receivable balance in the general ledger. We should know that. AR ledger is the accounts receivable ledger is the detail listing of the same information that is summarized. General ledger control account, AR ledger subsidiary. You can have subsidiaries for everything. You could have a subsidiary for accounts receivable, accounts payable, inventory. You're probably going to have one. You're going to have one for every item in your inventory, just about for every asset. Sales returns and allowances. Accounting for sales returns and okay, we haven't done these yet. Okay. Zoom. Sales returns and allowances. Okay, let's look at that journal entry now. Kutz, C-U-T-Z, Willie Kutz returned an item he purchased, and he paid $48.30 for that. And he returned it, therefore, he no longer owes us $48.30. So our accounts receivable has to go down to zero with the credit. We reduce the sale amount with a debit to the actual merchandise cost, because you never debit sales, only debit these contras, and we don't have to pay the sales tax anymore. We paid it back to Willie, okay? So what we did for Willie here in the general ledger, we do in the subsidiary ledger. So take a look at this guy. Before he bought this $48.30, how much did he owe us, Lori?
Wait, I'm sorry, say it again.
What was his balance before he returned the $48.30? Looking at his ledger.
Oh, okay, 602.70.
Well, that's afterwards. Yeah, he owed $650 before he returned this stuff. You got the right idea.
Yeah, sorry.
Yeah, he owed us $651, and now he doesn't owe us $48.30, so he brought his balance down to $602.70. Right. Then we have to put into the general ledger that amount. There's the general ledger side. Look at the sales tax payable. It was $563.7 before.
Right.
He apparently is a regular customer, and now he returned goods, and he does not have to pay sales tax on the items he obviously returned. So you have a credit to sales tax payable. And remember, the debit to sales is always going to be for the merchandise itself. It doesn't include any of those extra charges, okay? And that's an easy mistake to make, very easy mistake to make. Accounting for sales returns and allowances. Credit card sales. Do you do credit card sales at your company, Lori?
I do.
How much, may I ask what they charge you? 1%, 2%?
You know, I don't know what it is really. It's different on every sale. I go through a payment I have a couple of different payment platforms, and they just take the charge, and it's the percentage is not, it's not straight across the board.
Okay, that's interesting. Maybe it depends on what card they used or how much the money was. That's interesting. But as you know, Lori, when you sell something for $100 and you pay with a credit card, you're not going to get $100. You're only going to get maybe 98, right?
Right.
So what we're talking about here, class, is another contra revenue account called credit card fees or credit card discounts. I went into 7-Eleven today and I bought my daily jug of soda here for $2.50. And I paid with a credit card. Well, 7-Eleven is not going to get $2.50. They're only going to get $2.30 because Visa charges for each transaction. That's a great business, Visa. So it's similar to cash sales. It's the same thing as cash sales. As far as I'm concerned, credit card sales are cash sales. How soon do you know when you get the money in your bank account, Laura? Do you have any feel for that?
How soon from the sale to when the cash hits the bank?
For credit card sales, yeah.
It's generally about 3 to 5 days.
Really? Okay. Yeah, that's to me that's a little bit slow, but I still say it's cash because you've made that money already.
Right.
Okay. The credit card company makes electronic deposits to your account, the seller's account, for the gross amount of this credit card sale less a processing fee. And they're saying this is what you were just saying, I think, Lori. Fee is based on the gross amount of sales, including the sales tax. Okay. So take a peek at it. Oh my goodness, look at this now. We have the complication of selling something to somebody who used a credit card. So what do we have here? We have a sale of $100. They're calling that cash, which I like actually. So we got $100.80 here. That's the cash we received. 100, and then we got $4.80 in a bank fee. The sale was 100, and the sales tax payable was 105. Okay, in other words, the sale was 100, a credit to sales, credit to the sales tax payable, and they're showing you up here that the amount that the credit card is going to scoop up is $4.20. So that's a debit. And we're not going to receive $105. We're going to receive $100.80. Okay. Not too tough, I don't think, huh, Lori?
Not too bad.
Yeah. Journalizing cash receipts. Well, here we remember Lorenzo and you remember Brenda and all these people. They've come back. And some of them have paid their whole bill and some of them have paid partials. Well, it looks like Enrico paid the whole thing. I happen to remember those numbers, $1,596, and Brenda, $462. And the bank credit card expenses on these sales were $900. They had, in other words, they have received cash on account. Then they had some cash sales, and we had some credit card sales, which incurred a $900 charge. So guess what? We know we're going to be debiting sale, debiting sale. You have to tell you never to do that. We're going to be debiting accounts receivable and crediting sales because you never debit sales. Okay. Take a peek. I need to make this just slightly bigger. Let's take a look at our different transactions here, okay? The sale to Lorenzo. Well, we received a payment from him. In this group now, we're getting a payment. On the sale to Lorenzo, he paid us the $1,596. We credit accounts receivable. This is what we learned real early in the course. Same thing here. Myers paid so much on the account. We don't care if they paid the whole amount or not. The entry is going to be simply for what she paid us. Debit cash, credit accounts receivable, credit cash, debit cash. Oops, I'm sorry. Debit cash, credit accounts receivable. Now here was a cash sale. That's even easier. Debit cash, credit sales, and accounts payable. The only one that requires a little bit of thinking is the credit card sale. The credit card sale. And when you're trying to figure out these numbers, everybody, start with the sales itself. Do this portion, do the credit side first. what was the item we sold? Well, we sold a $22,500 piece of jewelry. That's the merchandise. That's the sale. There was sales tax involved of that amount. And in the problem, remember they said the bank credit card expense was 900. Did they say it was 800, Lori, or 900? I swear it said not 800.
I don't know.
I'm probably wrong, but no, I'm right.
Oh,
I'm right.
900.
I love catching these little mistakes that come up once. Okay, here we go. So take a look at that. We started by the merchandise. They sold one diamond for 22.5, whatever, 11.25 sales tax. But the credit card company took out 900. So we take these two credits, add them together, subtract the 900, and balance the journal entry with the cash amount. The cash amount. And we're going back into our favorite area here, the general ledger and the subsidiary accounts. General ledger, we already know this, huh?
Mm-hmm.
They paid us, and we have to credit AR, debit cash, and that has to go into the general ledger before it goes to the subsidiary ledger. So let's see what we have here. Okay. What are the accounts involved when you collect money? Cash, huh?
Mm-hmm.
Cash. This person paid us $462. So we're going to debit cash for $462, and we're going to credit accounts receivable. And it looks like that's what we did for everybody because there was no sales tax in those sales, I don't believe. So let's see what we have here now. Here is they're just showing us the first two. So here we debited cash and credited AR. Here's your credit to AR, 462. Here is your credit to the other one, 1596. So Enrico Lorenzo, he paid his bill. He owes us nothing. Same thing with Brenda Myers. Okay. The total of these ledgers, which in this case is 00, must add up to the balance over here. Okay. Control account, subsidiary. Ooh. Subsidiary. So yeah, your auditors are going to come in. They're going to look at accounts receivable. They're going to see that in this case, it's now 13 million something. Who owes this money to you? Well, you can say at this point, well, these two don't. You'd have to go to the other ones in that subsidiary. Now it's the end of the month, and we're doing our financial statements, and we have a subsidiary that agrees. The balance of all of these ledger accounts agrees that it adds up to whatever the balance is. At the end of the month, we're going to prepare a schedule of accounts receivable, and all that is going to be the name of the customer, how much they owe us. Next customer, how much they owe us, typically in alphabetical order, and that it will add down to the total of the subsidiary and the general ledger. The schedule of AR prepared to verify that the sum of the accounts receivable ledger equals the accounts receivable control account balance. And alphabetical or numerical, I've never seen it other than alphabetical, but you have different choices. And you do it at the end of the month, typically. Is that me or you, Lori?
That is me.
Oh, okay.
I'm sorry, I can't.
You can pick that up if you need to. No, okay?
Yes, sorry.
Okay, no problem. It's usually you prepare this at the end of the month, but you could do it every single day. You know, perhaps the sales manager is tracking these customers every day. He wants to see what's happening. Your person in the credit department perhaps wants to see it every day to make sure that some of these older guys have been paying. And it's just that balance is compared to the general ledger. And here we go. The balance in the general ledger at the end of the month was $14,331. the auditors come in and they say, who owes this money to you? And you hand this to the auditor. And you know what the auditor might do? The auditor might have you then sign a letter that says, dear customer, dear Helen Avery, according to the records of the Sunflower Cycle Company, your debt to them at the end of April was $2,302. Would you kindly acknowledge that to us? And they get enough of those back, and they start getting comfort that these numbers are correct. Okay. Accounts receivable schedule. Schedule of accounts receivable. Why are they showing it after we just looked at the schedule? It's prepared to verify the sum. Oh, they did it. I was too quick with the fingers. Okay, schedule of AR. I'm not going to talk about this too much. Finding accounts receivable errors. It's the same as any other error. You make a mistake, you go back over it, you trace your entries. Did they talk about the transposition errors here yet, Laura? You've heard about that, right? Do you know about those?
Yeah, I don't think it's been covered in this chapter.
Yeah, well, yeah, divisible by 9, right?
Right.
Yeah, if you make a mistake transposing numbers class, 81, you meant to write 81, but you wrote 18. The difference is 63. 9 into 63 is 7, comes out even. Same thing if you did 54 and you actually put 45, 9. 72 and 27, the difference is 45 divisible by 9. The reason I bring that up is that if you see a mistake, it could very possibly be a transposition error. So if you divide the difference that you're looking for by 9 and it comes out even, that's a pretty good clue that you just zipped one number against each other. Now, in this modern world of QuickBooks and other programs that you're using, you will never have the problem of putting in an unbalanced item. This transposition error trick was really important when you were doing it in pencil. You'd be off by $8,100 and you would just, oh, geez, it's divisible by, but it made things a little quicker. You can run your finger down every number real quick and then pop out that 8,100, usually quite quickly. There we go, Lori. What do you think?
It's a lot of stuff. It's very confusing to see it all on paper like this. It gets really cluttered, but yeah, it makes sense.
Yeah, it's not a buzzsaw of information. It's all fairly logical.
Yeah.
Exactly. You never debit sales, but you do debit the contra accounts to go from gross sales to net sales. If there's sales tax involved, that's obviously your liability, not the customer who's already paid it. And yeah, we want to make sure that if our ledger says we owe $1 million in receivables, we better be able to produce a piece of paper that says who owes us that money. So, okay. Now, in this chapter here is the receivables. When we get into the next chapter next week, we're not going to be talking accounts receivable. We'll be talking accounts payable. We'll be talking purchase discounts. We'll be talking purchase returns and allowances. Here, the returns and allowances, sales returns and allowances reduce our income, right? They reduce our income because they lower our sales. You're going to learn in the next chapter, purchase discounts increase our income because those are sales things we don't have to pay. Okay. Right. You got any questions, Lori? No, I think I'm good. What are we baking today? We're doing classic chocolate chip cookies. Good gosh, I do like a short cookie now and then, as we say. All right, well, if that's it, I'll let you go till next week. Okay, Lori? Okay, thank you. All right, class, we'll see you next week. Bye-bye. Bye.